Hello, everybody. Welcome to part 3 of my financial statement analysis. This is being done in February of 2022. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to move on to our next phase, which is we're going to be going through and selecting 2 ratios. And why 2? Well, I think it's better to kind of limit ourselves rather than expanding ourselves. And really what my goal is here to do is as I said in the very first part of this video series, I do not want you to mindlessly go through and compute ratios. We should be computing ratios that are relevant to the entities that we are going through and analyzing. So we're going to select 2 ratios for Meta platforms or Facebook and Twitter. Now, when we go through and choose this, now the one thing that you will be doing, and I'll do this on a separate video, is we will be computing the price to book ratio. I generally stay away from price to earnings. I will explain that when I do the price to book video, but here we go. So we have all these different ratios. And by the way, if you want to go to Investopedia, which is a great website, by the way, if you want to go to Investopedia and look up different ratios, please feel free to do so. And as we look at this, we've got a couple different things that are happening here. So when we look at liquidity ratios are oftentimes really going to be for companies where we are concerned with going through and how do we go through and determine if the company has the ability to go through and meet its obligations. Now, before I go any further, what I do want to just be mindful of right over here is that I do have this, and I will include this playlist. So let's just go to YouTube. I'll pause real quick. So I'm kind of assuming that before you're coming and watching this particular video, at least if you're in my class, that you have gone through and have familiarized yourself with what are liquidity ratios, what are activity ratios, what are profitability ratios, leverage and coverage ratios. So in going through and looking at this, you have to make sure that you're familiar with when we go through and use these. So let's just kind of go through and just do a brief overview. So for a liquidity ratio, this is going to be really for a company where I'm concerned if they have the ability to go through and to meet their current obligations. Activity ratios, these can be very helpful. If I have a large amount of inventory or receivables, it's really telling me how many times, how quickly am I collecting my receivables? How fast is my inventory turning over? The inventory turnover is very, very important in terms of determining inventory obsolescence. When it comes to profitability ratios, I can look at my profit margin, which is also sometimes gross margin, operating margin, and my net margin. Return on assets, return on equity, price to book, price to earnings ratio. And so again, as I mentioned previously, the price to book ratio will be done on the next video after we go through and look at some other things first. So for coverage and leverage ratios, we have our times interest earned. We also have debt service coverage, asset coverage, and then our debt to equity ratio or our debt ratio. Now for these ratios, this is really if we have a significant amount of debt on our financial statements. And I believe that in the very first video in the series, I showed you the example of Home Depot, which as of, I'm going to say the date wrong. I want to say it was October 31st, or for that 2021, they had about 39 billion of debt, somewhere around that area. For a company like Home Depot, because the amount of the debt is so large, the interest coverage ratio becomes that much more important. So let's now take a look. So what we're going to do before we go through and look at these ratios, we're going to go ahead and take a look at our companies. So let's take a look at our companies over here. And when we're taking a look at our companies, this is where we want to go through and we want to look at the common size financial statements. So when it comes to Meta platforms or to Facebook, if I just go through and kind of look at like, what is their current, do I worry about for Facebook if they're going to be able to make their payments on their debt? Well, when I look at Facebook has over here roughly about 41 billion of liabilities. They have about 100, and just in terms of their current assets alone, they have about 66 billion. So with Facebook, I'm not really as concerned with their liquidity. The other part over here in terms of Facebook is when I look at Facebook, Facebook is very profitable. And there's a couple other things in here as well as when we're looking at the current ratio or the quick ratio, those ratios here, if you have a company that is distressed, you probably want to be looking at the quick ratio, because what this is going to tell you is can the company can they pay payables? Is it a company that I want to be doing business with? If they can't pay me, probably not a good idea to be doing business with them. So for Facebook, the liquidity ratios really don't make a lot of sense to be looking at them. And again, it's just because they don't really have liquidity issues. They're able to go through and, they're pretty, Facebook is a pretty, or Meta Platforms is a pretty healthy company from that perspective. Over here, when I look at Twitter, okay, so these amounts, if I look at Twitter has about 48 billion of, 48% of their total balance sheet is in liabilities. Now, this is opposed to Facebook, which is a little bit healthier because they only have about 24% in total liabilities. But over here with Twitter, they've got about 48% of their total assets are, basically over here with liabilities. When we look at the different components over here, so accounts payable, very small part, accrued and other current liabilities, again, this is pretty small, but their current liabilities, like if I were to do a quick ratio, which is saying like their quick assets to their total liabilities, I generally, this is given that their current liabilities are about 10% of total assets and their current assets are about 56% of total assets. I'm not really worried about liquidity for Twitter. At least this is my opinion. Okay. This is not something, again, and when we're doing this, this is really just to kind of go through and explore like the different parts over here. So I'm going to skip the liquidity ratios for Twitter and for Facebook. Again, it just doesn't really make a lot of sense to use any of these liquidity ratios because both of these companies seem to be relatively healthy. For the activity ratios, I have over here inventory turnover. And if we look at inventory turnover, as I look at this, do Twitter and Facebook have inventory? Well, they do in the form of our own personal information, but that's not something that's going to show up on the financial statements. So it sounds really creepy, but it's totally true. So when we look at this, this is not, inventory is not something that is really seems to be showing up. With receivables though, so Facebook has accounts receivable of about 14 billion, which is about 8% of their balance sheet. Over here for Twitter, their accounts receivable is almost about the same percentage. So when you look at this though, is it really a significant percentage of the overall balance sheet? And I would say for these companies, because if I'm on Twitter, if I'm advertising on Twitter or on Meta platforms, and if I don't pay Meta, or if I don't pay, Twitter, they're going to pull my stuff off and I'm not going to be able to do business with them again. So if my, both of these companies rely heavily on, advertisers wanting to target certain individuals for their product, as we all know, when we go onto those sites, we see, oh, I was just looking at these Birkenstocks or these Rain Spooner shirts. I buy too many Birkenstocks, but I look at these different items and this is what I'm seeing advertisements for them. So there you go. Okay, so that's what happens, right? Birkenstock's most comfortable shoes in the world. All right, there you go. So right over here. So when I look at over here, so they don't really carry any inventory. I'm not as much concerned with the receivables. Let's talk a little bit about the coverage or the leverage ratios. So with Facebook, so for Facebook has no debt. So when I look at Facebook, and this is the primary company that I'm analyzing. So Facebook doesn't really have any debt. And when we look at these operating lease liabilities, we're going to find out a little bit later on that these are just bogus. And you see a same thing over here. This is just an overinflation of our financial statements, but that's okay. Those are the rules that GAAP has to follow. Yeah, it is what it is. So when we look at this over here, for our, there's really no debt for Facebook. Now for Twitter, Twitter does have, they did have some convertible short-term notes that it looks like that they were in fact converted. They actually have some long-term convertible notes. They have some senior convertible notes. So this is going to be a little bit more of a bigger percentage between the two companies. So, but however, it doesn't make a lot of sense for me to go through because my primary company is Facebook. I'm probably going to kind of stay away from some of those coverage ratios. Now, like the times interest earned, because Facebook has, or Meta Platforms has no debt. So this, if I was starting with Twitter, I would probably go through and look at this, but where I am, I'm probably going to skip it. So now, as far as the profitability ratios, this is where we get to be a little bit more of an interesting type of situation. So when I look at both Twitter and when I look at Twitter and Meta Platforms, what I'm really looking at is, well, how good are they going through and returning on their assets? How effectively are they able to go through and to use their assets? So over here, what we notice is that with Facebook, Facebook has about, as we're looking at their assets, they've got about 20 billion in terms of goodwill. They've got about 57 billion of property and equipment. So in my opinion, and then also over here, down over here too, when we're looking at stockholders equity, I personally believe that for these companies, that when I'm looking at my primary company that I'm looking at is Facebook, so what I'm going to probably go through and focus on is to look at the return on equity ratio and possibly as another ratio. So I think we're going to do return on equity. So let's put that down as one of our ratios. So we're going to do return on equity. And this is where it's kind of hard because this is extremely subjective, right? And oftentimes when we're going through and doing a ratio analysis, oftentimes it's more about, well, these ratios don't apply as opposed to these other ones applying. But I think though for Facebook, or for Meta Platforms, I think that doing a return on equity may be a good one to go through and to look at, just to see how well the owners are getting a return on basically on their equity investment. So we'll do the return on equity. And I think for the other one, let's kind of go back over here and take a look. So if I'm looking at Twitter, so in terms of, their total assets, so goodwill is about, 10% of total assets. Goodwill over here is roughly about 10% of total assets. If you want to have some fun, go back and look at some of the older financial statements of Meta platforms or of Facebook. What you're going to find is that this number actually hasn't really changed. But what you will see is that the total assets have changed. At one point, this was roughly, I think, about 18, and this number here was 50. So you can really kind of see how much Facebook has grown their business and how they've leveraged their acquisitions. So when we get over here and let's maybe take a look at for the income statement over here for Facebook. So maybe as we're looking at this, as we're looking at maybe possibly, let's take a look at the income statement for Twitter. So as I look at this over here for Twitter, so Twitter's in a little bit of a different situation. So Twitter, from an accounting perspective, Twitter was actually profitable in 2019, but they've been unprofitable in 2020 and also unprofitable in 2021. So as we look at this here, could we go through and do something like an operating margin or maybe doing a net margin? And that answer, I think, is going to be yes. But what I'm going to do is when I do that net margin, I'm going to be making a little bit of an adjustment to it, and I'll kind of explain why that is. So let's go ahead and do net margin. Okay. So I've chosen two ratios. Okay, why am I choosing the two ratios? So for the return on equity, the reason why I'm choosing this particular ratio is, let's go through and see what this means. So return on equity calculation, Investopedia. Okay, so right over here. So what this is this is going to be dividing net income by shareholders' equity. So it's basically return on net assets. ROE is considered a gauge of a corporation's profitability and how efficient it is in generating profits. So how do we calculate it? We're going to take our net income and we're going to divide it by our average shareholders' equity. So over here, okay. So for our net income, okay, we're going to also need some help going back a previous year. So what exactly is net income? And when I calculate these ratios, I'm going to calculate them for a period of 2 years. So for the net income for 2021, the net income for Facebook is going to be $39,370,000. What is my average shareholders' equity? Well, it's going to be my beginning shareholders' equity plus my ending shareholders' equity. And this is going to be collectively divided by 2. And this is going to give me my average shareholders' equity. So for Meta platforms, okay, for this one over here, well, my ending shareholders' equity right over here is going to be 124 billion. Okay, so this is ending 12/31/20. My beginning shareholders' equity is going to be my ending from the prior year. So when I come over here to Facebook, this number would be 128,290,000,000. Okay, so right over here, my average shareholders' equity is going to be these two items here divided by 2. Or actually, I didn't do that right. So this is going to be, yikes, Bennett, you're losing it. Here we go. So we're going to do plus let's do equals plus equals parentheses 124,879 plus 128,290 divided by 2. And now we have the true average. So over here are for our return on equity for Meta platforms. This is going to be roughly about 31%. So this seems to actually be, you know, a pretty good, this seems to be a pretty positive. This is a very good number to have like this high of a return on shareholders' equity. So when I look at Meta platforms for 2020, my net income is going to be, where we go. So for 2020, I'm going to go to my income statement for Facebook. This is going to be 29,146,000. Now for this, right, this is 2021 average shareholders equity. For 2020, I need average shareholders equity. I know that as of 12/31/20, this is going to be 128,290. What I'm now going to have to go back and do is I'm going to have to go back and figure out what it was as of 12/31/19. So if I come over here to company filings, and I'm going to come over here and look at all my 10Qs and 10Ks. I'm going to go to the prior 10K that was filed the year before. I'm going to go to item 8. And right over here, my shareholders, my total stockholders equity was at, right over here, 101.54. And what I'm going to do is I'm going to do a little Bob Ross here. We're going to go ahead and just copy this just in case I need to go back and use it later. So what I'll do here is I'm going to copy this down and I'll come up with a new color, right? So I'm taking 128 plus 101. I'm dividing that result by 2. And right over here. So over here. So for Meta platforms, my return on equity is going to be at about 25%. So this seems to be improving year over year for Meta platforms. So in terms of my return on shareholders equity. Now, before we go any further, there's also going to be something I want to talk to you about as well, especially as it relates to Meta platforms. One of the things that you're going to hear me talk about in the later videos is with stock compensation expense. This is a very important topic, especially for a company like Meta Platforms. And the reason why I'm looking more carefully now at stock compensation expense is because when stock compensation expense is recorded, meaning we are giving our employees shares, I'm debiting the expense and I'm crediting additional paid-in capital. When we have that situation, as we do over here, this has gotten to be such a large number that if I look at, we look over here at the net income is 39 billion, but what you'll notice is the amount of share-based compensation expense is almost 25% of net income. So as we look at this in our upcoming analyses, it's really important to kind of remember that we may want to be going through and adjusting net income for this non-cash item, but we'll talk about that a little bit later. But for right now, we're good on this front. The next thing I need to go through and do is I need to compute the return on equity for Twitter. And again, what's going to be the ratio? Well, right over here, we're going to have our net income. And my net income for Twitter is actually going to be a net loss. So over here, we have a net income or a net loss of roughly about 221 million. And in 2020, we also had like a net loss over here of about 1.1 billion. So in 2019, I just want to kind of write this out, is we're going to have to go through and do a little bit more digging, because what happened between 2019 and 2020 for Twitter, at least from a financial statement perspective, is something that I personally want to look at, just because, you know, this is a pretty wacko number, just because it's so going from this amount of income down to here is something's amiss. So let's go ahead now and figure out our average shareholders' equity. And again, if you're taking my class, you don't have to go through and you just have to show me 2 years. You don't have to go back and do this other year. This is something that I'm just doing just because it's something that I want to look at and explore a little bit more, just to base, so we can learn a little bit more about the company. So over here, our stockholders' equity beginning was about 7.3 billion, and this was as of December 31st, 2021. Our stockholders' equity for 12/31/20 was roughly about 7.9 billion. So over here, so now what we have to go through and do is I need to go through and find the ones from the prior financial statements. So let's go ahead now and go over here to Twitter. And for Twitter, what I'm going to try to do is I want to go to this annual report here, which is about 2 years back. The reason why is this is going to give me the information that I want in a pretty rapid place. So over here, my total stockholders' equity is for 12/31/19 is 8,704,386. And our shareholders' equity for 12/31/18 for Twitter. Remember, when we're looking at Twitter, these amounts are in thousands. So this is going to be 7.3 billion. Okay. So whereas for Facebook, those amounts are already in millions of dollars. Okay. Let's go. And then over here for Twitter, this is going to be 6,805,594. Okay. And I think what we may also want to do as well, because we're doing this third year for Twitter, we're also going to go ahead and do this for Meta platforms as well. But what I'll do is I'll do this in the background and you guys won't have to watch me do this. Okay. So first thing we're going to go ahead and do is we're going to go ahead and come up with our average shareholders' equity, and we'll come up with new colors for each one of these. Okay, so for 2021, for 2020, and then we've got for 2019. Okay, so what we're kind of seeing is that the return on equity, obviously, because we were at a net loss for Twitter, was about Over here, it's about 18.9%, and then some things appear to have happened, but then they kind of look like they're turning around. So let's check this out. So let's go ahead, and what I'm going to do really quickly is I'm going to go ahead and pause, and I'll come back once I've done it for Meta Platforms as of 2019. Okay, so we're back. So what we've done over here is we've gone through and we've computed. Essentially, we did an extra year, but I did that extra year just because when I looked at the information, it just didn't look right for Twitter. So what can we say about return on equity? So let's go back and look at what the definition of return on equity is. So return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity. Because shareholders' equity is equal to a company's assets minus its debt, return on equity is considered a return on net assets. It's a gauge of a corporation's profitability and how efficient is it in generating profits. So what I would say over here is that, as far Facebook is clearly a solid. Facebook has been delivering, or Meta Platforms has been delivering profits. Now, Mrs. Haugen would, as she showed us, it's how those profits are being delivered are sometimes going to be questionable. So that's something that when we look at this from a return on equity perspective, that is, Facebook is Meta Platforms is performing better than Twitter. So what I would say would be something along the lines of, if I was to be concluding on this, I would say that, that based on the ratio analysis, the return on equity is much stronger for Meta Platforms than of Twitter. And we would also want to comment that Twitter in 2020, they appeared to have had some challenging times. Now, if we want to go through and look at the income statement of Twitter, what happened between December 31st, 2019 and December 31st, 2020? Well, their revenues went up slightly. Their cost of revenue went up. Their research and development went up. Their sales and marketing slightly went down. Their G&A slightly went down. So over here, they had an income from operations, but their interest expense was pretty high, offset by interest income from their investments. So they had over here, and they had a income taxes of roughly $1 billion. So when we look at Twitter, that's a pretty big tax bill. It looks like something happened with their income taxes, which is what caused their income tax expense, which caused them to take a pretty significant hit. Now, what looks like may have happened, though, in 2019 is that they had a much larger write-off in 2019, and then 2020, it looks like that may have reversed. And then when we look at 2021, let's just kind of take a look at the numbers. Their revenue went up in 2021, but their cost of revenue also increased. Their R&D costs went up significantly. So these have really gone up a lot. Sales and marketing have gone up, very significant amount. General and administrative, roughly about the same, if not a little bit higher. Now, they also had a litigation settlement. What we would want to do is this a one-time thing, or is this going to be an ongoing party for the attorneys? Then over here, their loss from operations is about 492 million. Interest expense, interest income. So the other thing to remember too, and I'm kind of forgetting about this as well, is, we're in COVID. So I know we're coming out now with the masks off, but a lot of what could have impacted their business may have possibly have been COVID related, or a change in presidential candidates, or censorship. You never know. So in any event, I'm just joking around about all that stuff. It blows my mind. So all this over here, as we look at, Twitter, if we were now, for purposes of my class and you going through and doing this, is we would want to say that, okay, what is it, with the return on equity is higher for Meta platforms versus Twitter. And you would say that, based on the ratio analysis, the return on equity is higher for Facebook rather than that of Twitter. But what I would say, if I was doing this in real life, and if we were really going to be going through and fully analyzing this, we would want to get down into the nitty gritty and say, what happened to Twitter? Was that litigation settlement a one-time thing? What exactly was happening? Okay, so that's our first ratio. So let's take a look at our second ratio. And this is the thing about ratio analysis, is there's not one correct answer. Really, what I'm going to be looking for you to do is to show me your reasoning behind what's happening, right? So if I were to go through and to do this, I would try to put in the different numbers as I just went through and explained. That's what I would try to go through and do. So now let's look at, because we chose a ratio, we chose the return on equity over here. Now let's go and choose a different ratio. So what I do want to look at a little bit more carefully is, what is our total asset turnover? Let's see what this means. Okay. The asset turnover ratio measures the value of a company's sales or revenues relative to the value of its assets. The asset turnover ratio can be used as an indicator of the efficiency in which a company is using its assets to generate revenue. That might not be a bad thing. So if the higher the asset turnover ratio, the better it is. And again, for Meta platforms, they don't have debt. So and they're both, companies are both in pretty decent financial positions. So I'm really not going to be looking at liquidity or coverage. So I'm really kind of just choosing this because it's there, and I don't want to choose I don't want to choose something that's going to be similar to one of these that I've just done. So let's go ahead and use total asset turnover. So let's go to total asset turnover, and let's take a look at what that ratio is. So our total asset turnover ratio is going to be total sales, and then we're going to have beginning assets plus ending assets divided by 2. Okay, so so let's go ahead and do this. Okay, so we have Meta platforms for 2021. And this is going to be for 2020. So here's our ratio. And I'm just going to go ahead and copy this asset turnover ratio again. Investopedia is awesome. And I'm saying that for real because it's like I've had many a student who have shared with me that as they've gone through and done their studying, that they've referred to Investopedia more times than you can possibly imagine. So it's something that is something just to kind of keep in mind. And this below part down here, this is average total assets. Okay. So for Meta platforms, what this is going to be, my total sales is going to be for Meta. I can't believe it's still called that. 117 billion in total sales, thanks to you and me and our personal information. I'm just kidding. Maybe I'm not. Okay, so our total assets. So our total assets for 12/31/21, 12/31/20. So as of 12/31/21, our total assets were 165 billion. Our total assets as of 12/31/20 were 159 billion. So my average total assets is going to be 162 billion, and the value is just in between these. So we're going to go ahead and bring this over here. So my total asset turnover ratio is going to be about 0.72. Over here for the next year for Meta Platforms, my total sales for 2020 is going to be 85,965,000 over here. And my average total assets now I need to figure out what my total assets were for 2019. So fortunately, what I did is I copied, there we go, copy and paste right over here. If I come over here to look at, oh, wow, it took me right to it. How exciting. This is going to be 133,376,000. Just make sure I got that right. 133,376 total assets. And we'll make this one blue. There we go. Okay. Okay, so that's my total asset turnover for Meta Platforms. Let's go ahead and do this now for Twitter. So for Twitter, my total sales, I'm going to divide this by my average total assets. Good job, Bennett. Okay, here we go. Let's move this down a little bit. Okay, so my total sales for Twitter, it's going to be 5 billion. Over here, my balance sheet for my total income statement for Twitter is going to be 3.7 billion. So for my average total assets, didn't want to do that. Let's go here. Okay, so over here for Twitter, total assets were 14 billion as of 12/31/21. As of 12/31/20, this is going to be 13.39 billion. Or over here, a total of, some looks like the value is somewhere in the middle. And then over here, what we need to go through and do is to find the balance sheet for 12/31/19, or the beginning shareholders' equity. And this is going to be 12,703,389. Okay. And so as we look at this over here, the amount is 0.37. And let's just take a look at this here. So the asset turnover uses a value. So locate the assets. Okay, end of the year. So typically the asset turnover ratio is calculated on an annual basis. The higher the ratio, the better the company is performing, since the higher ratios imply the company is generating more revenue per dollar of assets. Okay, retail and consumer have relatively small asset bases, but high sales volume. Right over here, since the ratio comparing by industry is important, Okay, telecommunications. So over here, okay. So as we go through and we look at this, what we would say is, I mean, I think what I would simply say would be is that when I compare Twitter with Meta platforms. Hold on. Okay, so when I compare Twitter with Meta platforms, I would say something along the lines that the higher the number, the better. We would also want to kind of say, like, what is the industry? And, you know, clearly for Facebook, this is continuing to go up. However, I think Facebook actually recently, or Meta platforms recently issued some guidance that things may not be so rosy in the future, which is why their stock price has taken a pretty big hit. But we'll see what happens. But as we look at this, we would say comparing Facebook to Twitter, Meta platforms or Facebook has a higher asset turnover ratio. And so therefore, Facebook, Meta platforms appears to be better. I'm going to keep on messing this up. Meta platforms appears to be having more effectively using its assets to generate revenue. That's what I would go through and conclude by looking at these two ratios. So I realize that this ratio excursion was long. I know many of you like listening to me on 1.75 times speed just because it's easier to digest, which I completely encourage you to do. But at the same time, if you're watching my videos, it's because, and hopefully this is the case, that you actually want to see where the numbers are actually going through and coming from, which is what I'm trying to deliver to you. So with that all being said, I want to thank all of you for being with me here today. If there are any other videos that you would like me to go through and review, please feel free to leave me a comment. And again, I want to thank you for your time today. And don't forget to like and subscribe. And if you would like to see some other videos made in the future, feel free to reach out. Thank you so much.